India's dependence on imported oil for over 85% of its needs makes the country extremely vulnerable to rising crude prices. The US-Israel war against Iran, which is now in its fifth week, has pushed oil prices over 50% this month. That has been the Achilles heel for Indian stocks and the rupee. The surge in crude to above $114 per barrel has raised concerns over inflation and macro stability. We decode this impact of the Iran war with India in this next report. Take a look.
Indian stocks wrapped up their bleakest month since the COVID sell-off in March 2020. The Sensex and Nifty crashed over 11% in March, capping off their worst fiscal year since 2020. Indian benchmarks also underperformed other Asian and emerging market stocks. Foreign investors sold a record $12 billion worth of domestic stocks, surpassing the previous record of about $10 billion in October 2024. Total outflows this year have exceeded $13 billion and nearing levels seen a year ago. Investors now say there is a lack of compelling narrative to draw global funds back, even if the conflict eases in the near term. The rupee crossed 95 against the dollar for the first time, marking a third consecutive day of historic lows. Even before the war, investors were grappling with a weak rupee. This week's moves are a reflection of the extreme fear among investors. After surging as much as 1.4% to 92.9 per dollar at the Monday open from a low of 94.8 per dollar on Friday, the rupee gave up gains and hit a fresh low in the final stretches of trading. The currency crashed to a new record low of 95.6 rupees to the dollar before closing out the session just above 95 per dollar. The wild gyrations come despite measures announced by the Reserve Bank of India. India's central bank announced a daily currency position limit of $100 million for domestic banks. That move was aimed at reining in speculators betting on a further fall in the rupee. However, the historic energy shock has worsened the pressure on the currency, and the impact of RBI's measures was only short-lived as war fears triggered panic selling. The rupee's reversal shows that the currency weakness is deeply structural due to elevated oil prices. Crude importers rushing to buy dollars also hurt the rupee. Bets are that the trade deficit will widen further for the import-dependent country. India's heavy reliance on oil imports is straining the country's current account deficit as the Iran war drags on. The current account deficit is expected to widen, with estimates suggesting that it may reach 2.5% of GDP from the current concerns over surging energy costs, which are overshadowing the nation's long-term growth story. Analysts warn of ongoing caution due to potential inflationary pressures which could affect India's growth and earnings. MK Research had predicted that if Brent rises to $100 a barrel, the country's growth rate would fall to 6% from the above 7% pre-war baseline bets. The Iran war has now pushed Brent prices to about $114. That suggests a large shock for the country. If Brent rises to $130 per barrel, MK Research forecasts current account deficit to widen to 3.7% of GDP from 1.3% before the war. The balance of payment shortfall is expected to widen to $138 billion from $15 billion. Inflation is predicted to surge to above 5% from about 4%, and growth rate is expected to fall to a low of 5.4%. The country is also likely to face a capital account deficit as foreign investors flee from Indian markets. Some analysts say it could be the worst since the balance of payment crisis in the early 1990s. Soumya Kanti Ghosh, Group Chief Economic Advisor of State Bank of India and a member of the Economic Advisory Council to the Prime Minister, said this has never happened since 1991. Crude price pressures has prompted Goldman Sachs to cut India's 2026 growth forecast to 5.9% just last week. And that comes less than 2 weeks after the group lowered growth to 6.5% from 7% previously. Business Bureau, WION World is One.